Why do gas prices shoot up when there's a war thousands of miles away? Why does a single shop owner's pricing decision mean almost nothing to the national economy? Yet millions of those decisions together change everything. The answer lives inside two powerful branches of economics: macroeconomics and microeconomics. By the end of this video, you'll understand exactly what each one is, how they're different, how they're connected, and why they matter to every single person on this planet. Welcome. Today we're breaking down two of the most important concepts in all of economics. We'll cover what macroeconomics is, with definition and real examples. What microeconomics is, with definition and real examples. The key differences between them. How both fields affect the financial world, and why understanding both gives you a massive edge in life, business, and investing. Let's start big. Literally. Macroeconomics is the study of the economy as a whole. Think of it as the bird's eye view, zooming out from individuals and businesses and looking at entire nations, regions, or even the entire global economy. Macroeconomists ask questions like, is the economy growing or shrinking? Why is inflation rising? What happens when a central bank raises interest rates? How does government spending affect a country's debt? These aren't questions about one business or one person. They're about the whole system. Let's look at three powerful real-world examples of macroeconomics in action. Example 1. The 2008 financial crisis. When the U.S. housing market collapsed, it triggered a global recession. Stock markets crashed worldwide. Millions lost jobs. Banks failed. This is macroeconomics. One national crisis rippling across the entire global economy. Example 2. Inflation in 2022. After the COVID-19 pandemic, governments around the world injected trillions of dollars into their economies to survive the crisis. The result? Inflation hit 40-year highs in the United States and Europe. Macroeconomists had debated this exact consequence for decades. And then it happened in real time. Example 3. China's GDP growth. China lifted hundreds of millions of people out of poverty over 3 decades through deliberate macroeconomic policy, controlling trade, managing currency, and directing investment. That is macroeconomics, reshaping an entire civilization. The key variables macroeconomists track include GDP, gross domestic product, the total value of all goods and services a country produces, inflation, the rate at which prices rise over time, unemployment rate, the percentage of people who want work but can't find it. Interest rates, set by central banks to control borrowing and spending trade balance, whether a country exports more than it imports, or vice versa. Now let's zoom in, weigh in. Microeconomics is the study of individual economic actors, a single person, a household, a business, or a specific market. Microeconomists ask questions like, why does the price of coffee rise when there's a drought in Brazil? How does a company decide what price to charge for its product? Why do consumers buy more of something when it goes on sale? How do wages get set in a competitive labor market? These are ground-level questions. They're about choices, individual, rational, sometimes irrational choices. The most foundational concept in microeconomics is supply and demand. When demand for a product rises, say, everyone suddenly wants electric vehicles, and supply stays limited, prices go up. When supply increases faster than demand, like when new factories open, prices fall. This simple relationship governs nearly every price you see in the market. Let's look at 3 microeconomic examples in the real world. Example 1. Uber's surge pricing. When it rains and thousands of people suddenly need a ride, Uber raises its prices automatically. This is microeconomics. Supply of drivers versus demand from passengers, priced in real time. Example 2. Apple's iPhone pricing strategy. Apple keeps prices high and creates artificial scarcity to maintain the perception of premium quality. Meanwhile, competitors like Android manufacturers compete on price. That price competition is pure microeconomics. Example 3. The labor market for nurses. During COVID-19, hospitals desperately needed nurses. The demand spiked, supply was limited, and wages for travel nurses exploded, sometimes to $10,000 a week. Microeconomics predicts exactly this outcome. Key concepts in microeconomics include supply and demand, the fundamental forces that set prices, elasticity, how sensitive buyers and sellers are to price changes, marginal utility, the satisfaction you get from consuming one more unit of something, market structures, perfect competition, monopoly, oligopoly, and monopolistic competition, game theory, how businesses and individuals strategize when their decisions affect each other. Now let's put them side by side and look at the key differences. Think of it this way: microeconomics is the tree. Macroeconomics is the forest. Microeconomics asks, what's happening with this one tree? Is it growing? Is it healthy? Why is it leaning left? Macroeconomics asks, what's the overall health of the entire forest, and what climate conditions are affecting it? But here's the critical insight. The forest is made of trees. You cannot truly understand macroeconomics without microeconomics, and vice versa. They are interconnected at every level. This is where it gets fascinating. Macro and micro don't exist in separate bubbles. They constantly influence each other. Consider this: when millions of individual consumers, acting on microeconomic logic, decide to spend less money because they're worried about job security, the combined effect of all those individual decisions causes a drop in aggregate demand. A macroeconomic concept. That drop can push an entire economy into recession. Conversely, a macroeconomic decision, like the Federal Reserve raising interest rates, directly impacts microeconomic behavior. A business owner now has to pay more to borrow money, so they hire fewer people. A home buyer sees mortgage rates double and decides not to buy. These are individual micro-level responses to a macro-level policy. The two systems breathe together. Macro sets the climate. Micro determines how each organism adapts to it. Now let's talk about money. Specifically, how both branches of economics shape the financial world you live and invest in. Macroeconomics drives markets at the highest level. When the U.S. Federal Reserve raises interest rates, bond yields rise, and bond prices fall. Stock valuations get compressed because future earnings are discounted at a higher rate. The dollar strengthens against other currencies, hurting U.S. exporters but helping importers. Emerging market economies that borrowed in U.S. dollars suddenly find their debt much more expensive to repay. All of this from a single macroeconomic decision by one central bank. GDP growth rates tell investors whether to expect corporate earnings to expand or contract. Inflation data shapes expectations for monetary policy. Unemployment numbers signal whether consumers have money to spend. Every major asset class, stocks, bonds, real estate, commodities, currencies, is deeply sensitive to macroeconomic conditions. Microeconomics, meanwhile, drives individual investment decisions and business performance. When a company like Amazon enters a new market, existing players face a microeconomic threat to their pricing power and market share, and their stock prices reflect that. When oil supply is disrupted, think OPEC cutting production, the microeconomics of the oil market causes price spikes that ripple into inflation, transportation costs, and airline stocks. A company that masters microeconomic principles, understanding its cost curves, maximizing its pricing power, reading consumer demand elasticity correctly, will outperform its competitors even in a difficult macroeconomic environment. Warren Buffett famously looks for companies with moats. a microeconomic concept describing a firm's ability to sustain competitive advantage and pricing power over time. That's micro-thinking applied to long-term investing. The most successful investors, economists, and business leaders are fluent in both. They read the macro environment to understand what headwinds or tailwinds are coming, and they analyze microdynamics to find the specific opportunities within that environment. Right now, in today's world, both are at work simultaneously. Macroeconomically, central banks around the world spent the past few years battling inflation by raising interest rates, the highest rates in decades in many countries. Now the debate is when to cut rates and how to avoid triggering a recession while keeping inflation under control. Microeconomically, the rise of artificial intelligence is reshaping labor markets. Some jobs are being automated, creating downward wage pressure in certain sectors, while demand and wages for AI engineers skyrocket. This is textbook microeconomics. Technological change shifting the supply and demand curves for specific types of labor. Both forces are happening at the same time, interacting with each other, shaping the financial world you navigate every single day. Let's bring it all together. Microeconomics studies individual decisions, how people, businesses, and markets behave. It explains prices, production, wages, and competition at the ground level. Macroeconomics studies the economy as a whole: GDP, inflation, unemployment, monetary policy, and fiscal policy at the national and global level. They differ in scale and focus, but they are deeply interconnected. Micro decisions aggregate into macro outcomes, and macro conditions shape every micro decision made. Together, they are the lens through which we understand the financial world. Why markets move, why prices change, why some countries prosper while others struggle, and why the decisions made in central bank boardrooms ripple all the way down to the price of your morning coffee. If you found this video valuable, subscribe. We go deep on economics, finance, and the forces shaping the world every week. Drop your questions in the comments. What macro or micro topic do you want us to break down next? See you in the next one.